All right, let's get started. Thank you everybody for joining us today. My name is Andrew Lucas. I head investor relations at Tryon Properties. We're here today to discuss Azure at Riverside in Austell, Georgia. If this deal looks familiar to you, it's because we did a webinar on this property about 3 or 4 months ago. And during, from when we originally recorded it to where we are now, the world has changed significantly. And we also completed our due diligence on the asset. And long story short, we're holding an updated webinar because we were able to negotiate a $12 million price reduction. Originally, we were looking at this asset at $56 million. And now we are buying it at $43.6 million. So the deal itself has really changed. There's some stuff that we did uncover during due diligence we do want to talk through. So we thought it would be prudent just to update everybody. Next slide, please.
I'm trying. There we go.
So yeah, with us today is myself, Max Sharkansky, who's our managing partner, Adri, who is our acquisitions associate in Miami. And we actually are fortunate. We thought Marley was going to be traveling during the webinar, but he was able to join us. So his picture's not here, but he is with us as well. And he is the one who sourced this deal and is closest to it. So he'll discuss the merits of this opportunity. Next slide, please. So, I know many of you are familiar with us, but we do have some new faces here. So just a little background on Tryon. We are a vertically integrated owner operator of apartment buildings in the Western and Southeastern states. We own in California, Oregon, Colorado, North Carolina, South Carolina, Florida, and Georgia. And we've done about $1.5 billion in total acquisitions, about 80 properties in total. And we have exited 47 assets. On the 47 assets that we have exited, we've averaged investor level IRRs of over 30%. So we've got a pretty robust track record, a proven repeatable model. And we're not promising or targeting returns like that in this current environment. But again, we've historically been able to underpromise and overdeliver. And really for us to buy a deal, which Azure falls right down the fairway for us, there needs to be very compelling reasons as to why we're confident that we can really increase that net operating income and ultimately drive the value. So again, Azure really is a straight down the fairway opportunity for us where we think we can really increase that net operating income. Next slide, please. So here's just the high level bullet points of the deal. Again, we're buying this property for $43.6 million, which is a substantial, a $12 million reduction of where we were initially looking at it. So I'm going to now pass it over to Max. He's going to discuss basically how we were able to negotiate that discount, what we uncovered in due diligence. And then after he touches on that, we'll flip it over to Marley to really discuss the minutia of the deal, why we think it's a great opportunity. And with that said, we do have a Q&A box. So if anybody has questions throughout this presentation, feel free to type them in and we'll answer them at the end of the presentation. And then one more note, so this specific property, we are offering the ability to invest directly into this deal. But then you can also get exposure to this property and a portfolio of other multifamily properties by investing in our third fund. So Fund 3 will be investing in this asset. It currently has investments in 11 assets. This will be its 12th investment, and ultimately it will be spread over a pool of about 15 to 20 different properties in the Western and Southeastern states. So with that, I'll turn it over to Max. Feel free to ask any questions if you have them. Take it away, Max.
Thank you, Andrew. As you can see here, 43.6 million is actually a projected price. And let me tell you what I mean by that. Our contractual price is 44 million, but we have a stipulation in the PSA that says we get a $40,000 per unit credit for any unit more than 6 units that has a delinquency. There was some delinquency earlier on. We came back on that after our due diligence. And that was what we agreed to because we very much wanted the seller to clean that up. We did not want to inherit all of that. And we think at close, it'll be about a $400,000 credit towards the purchase price based on the delinquency. We also received a credit because of the vintage. It was represented to us that the vintage was 1979. but it's actually 1973. And a lot of you are thinking, what's the big deal? It's just 6 years. Why is that so valuable? Because in 1978, the world changed when it came to construction, and properties built after 1978 do not have asbestos, which changes the execution of the construction and the liability and how you go about handling abatement. So we asked them for a pretty significant credit for those reasons, and they gave them to us. There were also significantly more evictions than we had originally underwritten, and part of that credit was for that too. So it was vintage, it was everything that comes with the new vintage and evictions, and then as these things were happening, the market was going down. So we made sure to get enough credit to where we were able to buy it and have the seller meet the market. Otherwise, we said we're just going to pull out and get our deposit back out. As you could see, the project level, investor level metrics, the returns have all changed. We also made some of our assumptions a little more conservative. We increased our exit cap. I think we were originally at a 4.6. Now we're at a 5. That's a huge increase. Again, the world has changed, and that's why we got a huge credit, and we want to make sure to be conservative, and in the spirit of conservatism, change our underwriting as well. Something that's not included here and that we've been discussing internally is we might layer in a little bit of preferred equity because our senior loan does have a pretty low loan to value. It's about 61, 62% right now. We would like that to be a little more, what we think is market, which is 70%. So we are discussing increasing our leverage to about 70% of cost. And that would increase the project level IRR to around a 30 and the investor level IRR to around a 23, 24. But nothing solidified there yet. We're exploring it. And if we do decide to do it, we'll let everybody know via email. So just, a quick overview on the asset. It was in fact built in 73. It's a mix of 1s, 2s, and 3s, very large units, 1,000 square feet. A lot of work has been done to the asset, both by the previous two owners. They did get caught in the eviction moratorium here, which is why the asset really isn't stabilized. And I would definitely say this is a little more than value add. This is bordering on distressed, or maybe not, that's a little bit too strong of a word. I would say it's more opportunistic on the risk spectrum. As you can see here, it's got 15% vacancy. It's got quite a bit of delinquency, which is why we have the stipulation that we do. And the reason they have that, a lot of you are probably thinking, well, is this a crummy demographic? It's not. The reason it's got that is because, similar to California and Oregon, it's got an eviction moratorium, but the eviction moratorium here from our research is based on capacity at the sheriff's office. It is not based on politics. What the law here says is you're allowed to evict 5 units per property per month. And again, that's strictly based on sheriff's department capacity. With regard to the demographic here has been improving over the last 10 plus years. They have built 60 million square feet of industrial in this pocket. When you get some time, please go to Google Earth and look at an aerial of the asset, and you will see nothing but industrial rooftops directly across the street. You could practically throw a rock at the Amazon Logistics Center. Just fantastic jobs in the area, and we have invested in areas like this and love investing in areas like this. We have discussed a strategy of growing our portfolio in areas like this. And when I say areas like this, I mean areas that have been historically pretty low on the socioeconomic ladder. Then you get industrial that comes in and everything changes. You go from a service-based tenancy to a more, I would say, gray collar, upper blue collar, 25 to $30 an hour versus 12 to $15 an hour. Your rents skyrocket. I believe the annual rent growth here over the last 10 years has been 10% plus, and that's not just based on the last couple of years. It's been a very steady, 8 to 10% plus rent growth. Fantastic market. Next slide.
Can you hear me better now?
Yeah, that's great.
Okay, perfect. Okay, so just one last thing on this slide. I was just mentioning, these are typically larger units. They're a little over 1,000 square feet each on average. Typically, your unit mix is going to be more in the upper 700s, low 800s. So these are larger units with a lot of 2 and 3 bedrooms. Touching on what Max said too, is that the 2 biggest drivers of the industrial in the area, one is the Atlanta airport, which is only 15 minutes away. And that airport is expanding its capacity. And then the other thing is the Savannah port. A lot of people know Savannah port is already one of the largest ports in the US. It's doubling in size in the next 6 months. It actually has 2 phases, one starting in 6 months, the other one starting about 6 months after that. But within the year, it will double in size. And the Atlanta market is the closest kind of large industrial market to that. So this area will continue to grow based upon those 2 things. And it also sits right on Highway 20, which is the major east-west road corridor in the area. So it's a fantastic location for all those reasons. This is talking about a lot of what we just said with this location to Atlanta. Downtown Atlanta is also, it's 11 miles away, which is about a 15-minute drive. What's happened is just like Miami and some of these other cities, the downtown market has skyrocketed in terms of rental rates, and people are simply priced out. So they can move to an area like this, 15 minutes from downtown, and it's half the price. So it becomes a lot more affordable. This is what we've covered. The one other thing on here is, this is of the markets that we've looked at. There's one of the larger disparities from what it costs to buy a similar size home versus renting. The average home price here is in the mid 500s for a 3-bedroom house. Given that this property has a lot of 2s and 3s bedrooms, that's something like fairly comparable. So where we're underwriting a little over $1,700 for a fully renovated 3-bedroom, your all-in housing costs just down the street for a similar size house is going to be $3,000. So it's just a huge delta, and that's not including the fact that you have to put the down payment and qualify credit and all of those things. So this is one of those markets where there's just a higher percentage of people. It's a lot more attractive to rent than it is to buy. And then the last thing, if you look in the middle here, you see some of the expansion coming up. Supply One, 250,000 square feet of industrial. Pratt, 400,000. Bang Energy, 600,000. ASP, 300,000. This is all new stuff that's coming online in the next year. So that will be a tremendous amount of jobs in the micro area. And there's a lot more announced beyond that as well. So the investment into this property and our value add strategy. So this property was 2 owners ago, essentially. They bought this essentially from a slumlord who hadn't done much to it in quite some time. That owner put a tremendous amount of money into it. This property has new roofs, new exterior siding, new windows, new sliders, new balcony railings. More than half the HVAC units are new. The clubhouse has been updated. There's just a tremendous amount that has been put into this property to where it almost looks like new property. It presents very much like a mid-'80s deal rather than 73. So we benefit from all that's put into it. The current owner inherited it less than 50% economically occupied. The reason why that was is because as the previous owner was doing a major renovation, they cleared out and had to clean up, tried to start cleaning up a lot of the tenants. The current owner inherited that. And most of what they've done is been cleaning up the rent roll. So they haven't focused on renovating the interior units because they've been focused on improving the tenant mix. So our value add is going to be to renovate roughly half the units. We'll leave the other half unrenovated to leave that as upside for the next buyer, which is why we're underwriting a 5 cap. If we were to fully renovate, that's probably the equivalent of a 5.5 or a 5.75 cap. So we feel we're being pretty conservative there. And the reason why there's a compression at a 5 cap is because there's still going to be a lot of upside for the next purchaser. So as I mentioned, we're renovating a lot of the interiors. On the exterior, since a lot of the structural stuff has already been done, Where they stopped for some inexplicable reason was kind of the pretty stuff. So they did all the grading on the site, but they didn't do the aesthetic landscaping improvements. They fixed the parking lot, repaired it, but they didn't do a top coat and repaint it. And then on the exterior paint, they only painted half the building in a really nice gray, but the other half is the raw siding color, which is kind of a yellowish beige, and those two colors just don't go together. So these are very, very easy wins for us. We'll go in and we'll give a top coat on the parking lot and new paint and striping. We'll paint the second half of the property, and then we'll enhance the landscaping. So it's going to look entirely different than what it currently does, and it's not going to cost us a tremendous amount to do it. Okay, so this is what we went over. Max went over the building more. So this is actually a key point we didn't go over. Historically, this area, as Max mentioned, has been a lower income area. Rents have been lower. As the area's improved tremendously, there's been a lot of pushback from some of the residents regarding affordability. And so what the city, what this particular area has done is they put a moratorium on new multifamily units. That's not going to last forever. To get approved for new units in the future, you're going to have to build affordable units as part of your development. This is great for us because it means two things. One is there's a pause in the amount of supply. And then the second thing is once supply is again permitted, it's going to have to be at significantly higher rents because you have to build affordable units, which by law have lower rents. You have to make up for it on your other units. So this is a huge advantage for people that currently own in the area. So here's some of the photos. You can kind of see here, they did all the grading. So that's why you see a lot of dirt there. Fortunately, the grass is actually starting to grow. So that's going to save us a decent amount of money. But historically, it's been dirt. But you can see they have a lot of nice trees and old growth trees and things like that. If you look in the background of this photo, it's a little bit hard to see, but you start to see the white roofs that Max was mentioning about the logistics. They're literally across the street. They're walkable. The residents don't even have to drive. Here again, you can see where there was a lot of dirt historically. It's a little bit tough to see from this picture, but there's actually nice kind of rolling hills. It creates a nice topography to the site. And you can see this doesn't look like a 70s product. This is exactly what we expect to see on an 80s product in terms of the building architecture itself. The editing that the photographer did on the colors of the siding here make it look much better than it currently does. The gray is nice, the white trim that you can see, but you can see the beige on the right where they just left it as the raw siding color. So we'll go in and we'll improve that and it'll look significantly different. And then of course the landscaping you see is primarily dirt and pine needle. So we'll improve that. They did do a nice sign, landscaping at the front. The pool, this is an old picture. In the last 2 months, I believe, the pool has been completely resurfaced. So we'll do a little bit of work here, maybe some nice furniture, barbecue area. This is sports court. Here's that beige siding. This is the clubhouse. It's been updated. We'll do some updates here. We have a budget for some furniture and things like that, but it's been largely done for us. A few of the units have been renovated. This is an example of one. They've done Formica countertops, new cabinet doors, bathrooms. They put LVP in some of the units. Another thing, by the way, all the units have washers and dryer connections, but they haven't installed washers and dryers. This is both a competitive advantage and one of the easiest wins that you can do in any market. So part of our budget is to put washers and dryers in all units. As a lot of the properties in the area are of a similar vintage, many of the properties don't even have the opportunity to put washers and dryers in. So this will always remain a competitive advantage for us. Went through this. Here you'll see under noteworthy announcements a few more industrial Stitch Fix, almost a million square feet just down the street. It's just such a, I mean, it's literally, I think it's 6 or 7 million square feet coming in over the next couple of years. It's a huge number. So the deal metrics, as Max, total capitalization is a little over 50 million. As Max mentioned, we currently have a term sheet with Capital One for a little over 30 million of debt. That's about a 60% LTC. We are looking at adding a pref equity piece above that, which will enhance returns by about 300 or 400 basis points. We're still working on that, so we're not showing that today. This is the conservative case for us, what we're showing here. It's the operating P&L. We're planning on holding 3 years. Because of the evictions, there's a little bit higher vacancy, as we were mentioning before, which will allow us to get a head start on the renovation of the units. Over the last couple of years, it's rare that we find properties with more than 5% vacancy. This will be somewhere between 10 and 15%. So we'll be able to get a head start on renovating the units faster. So we don't believe that we need to hold more than 3 years to get through half the units. And then this is the investment cash flow with debt service. As I mentioned, a big part of what we're doing here is upgrading interiors. We'll put in LVP, stainless steel, cabinet doors where necessary. This is a lot of the same that we do in all of our units. Here's the floor plans. You can see a lot of 2 and 3 bedrooms. So here's some sales comps. We're going in at about 163,000 a key. That compares very favorably. There's a deal just down the street from us that is probably a few weeks from closing, called Midwood Riverside. It's mainly 2-bedroom 2s and 3s as well. It is not nearly as nice, both in terms of micro location, architecture, amenities, and current condition of interiors. And that's trading for what was it, 165 a key, I believe. Roughly the same price as what we're paying, and this is a superior asset. And then you'll see, by and large, the comps are relatively in range. Oops. So here's the rent comps. This is another great picture where you can see all those white roofs. That's all the logistics, industrial. So you can see it's pretty much everywhere. Our property is right in the center. What's also nice is, if you're looking at this map, you'll see the purple circle is our property. If to the left of that, you see Lake Crossing apartment homes. Where that word lake is, along that corridor is a fairly new retail area that's quite nice. It has all the retail amenities you could ask for, including car dealerships for that matter, grocery stores, restaurants, any service retail that you need. So it's just down the street. It's really convenient. As I mentioned, we're also right on Highway 20, and you can see off to the right 285, which is the north-south, the major north-south corridor that goes around Atlanta. So it's a very, very convenient location. The Midwood Riverside deal I mentioned, you can also see that on the map here. That's just to the right and to the south of our property. The north side of the highway, by the way, is the better place to be. Midwood is on the south. Here's the rents per square foot. You can see we're pretty much in the middle of the pack. Our renos should be as good or better than pretty much everything on this list. So to be in the middle of the pack feels right. Some of these properties, like 300 Riverside, where we're noting that it's a partial renovation, that's a very, very light partial. Whereas we're going to do a full renovation. So it's not necessarily comparing apples to apples there. That property was also just purchased, and it needs a significant amount of exterior CapEx and deferred maintenance done to it. Here are the 2 bedrooms, same story. And the 3s. And you can see here we're underwriting. I mean, for the largest one, 1450 square foot at 1820 rent. To buy a house roughly that size is in the $500,000 range, maybe a little bit more, and you're talking about nearly $3,000 of all-in costs when you factor in taxes and insurance and all of that. So this is Midwood Riverside. This is trading at almost the same price per key as Azure. You can see it is not the same quality. Sweetwater. We have this one. Our rents are coming in underneath this. Our interior should be nicer, but the overall property of Sweetwater is more attractive. So the key things we're looking at here, this area has better than average job growth. Vacancy is going down, and with the permit moratorium and the upcoming requirements for affordable housing, the vacancy is only going to get lower. As Max mentioned, logistics is something that it's an investment thesis that we have, and frankly, a lot of buyers currently have as that industry grows and grows and the incomes increase. You can see the rent growth here. Just like many of the Southeast markets, it's basically through the roof. Expected to continue. Strong population growth. Purchase price, you can see here in our micro market, the current average price per key is a little over 205,000, and we're at 163,000. That's a great place to be. Obviously, that's a mix of product quality. There are some that are way worse and some that are better, but this is a good price per pound for the market and the quality of the asset, especially given how much CapEx has put into it already for us. Supposed to be strong rent growth continuing. This is a little better than what we see in your typical Southeast market. I think part of that is the upcoming lack of supply, and the other part of that is the several million square feet of industrial coming in, and therefore really robust job growth. So on average, CoStar has rent growth at 5%. That's what they're forecasting for this market. Reese, probably the second biggest publication, is a little over 4%. We're at 4%. So we think we're safe there. And then you can see deliveries from where we are kind of at the end of 2022. There's less than 500 units coming in over the next year and a half, which is a very small amount. And then after that, there's very little planned. Actually, CoStar includes planned as well in here. And I'll be surprised if most of those will either be delayed or won't get permitted based on the new moratorium and the new affordable housing requirements. So exit cap. As you can see here, both in Atlanta and the Cumberland Galleria market, which is where we are, this will be a kind of low 4-star property when we're done based upon vintage. You can see they forecast it to stay sub 4.8% exit cap. We're underwriting 5% exit cap with additional upside for the next buyer. Again, apples to apples, that would be more like us underwriting a 5.5 or 5.75 on a fully renovated property. So we think we're being really conservative there. Household incomes. You can see within the 2 mile, they're 82,000 average, 60,000 median. which means that the vast majority of the population can afford our average rents. It's just the population growth. So summing it up, we feel really good about the price per key now that we've had the price reductions. The market average rent is $1,580. We're at $968 currently. We're underwriting that we get to around $1,500. So we expect to be around the average post renovation, but we feel that that's conservative because we'll have the newest renovation at that point, yet we're only assuming average rents. The vacancy is 15% currently physical. The market average is 5%, so we know that there's a big upside there. We talked about the upcoming supply. There's only 407 units. And then in the next 2 years, it's about 500. I guess the 400 is averaging that out over the next 2 to 3 years. And then, of course, just the massive, here you go. The number is 5.1 million square feet in the local area currently under construction. There's more planned. That is a very, very large number. So that'll result in a decent amount of jobs. I think that's it.
I've been answering Q&A in the Q&A box as we've been going. Are there any other questions?
Looks like there's two open questions.
Yeah, there are.
To what extent?
The pref is a third party. Oh, sorry. The pref isn't something that we're investing.
No.
We're getting pref from a third party, so that won't be part of the investment.
Great. And guys, what I did, I posted the link to get access to the data room, which will have the PPM, the deal brief, all our track record, all of the investment materials in the chat room. So feel free, if you click that link, put your name and email, you'll get access. You'll get an email giving you access. We're closing September 14th. So funds will be due in the week prior on September 6th. And we will, if you already have access to that data room, you'll get an email momentarily inviting you to subscribe. So we hadn't been accepting commitments. After this webinar, I will send an email out inviting you to subscribe. So if you go through and execute your documents via the portal, that'll secure your space in this investment.
And I'm going to answer a few more questions. And everybody, please also look through all the Q&A because I've been answering Q&A the entire webinar. And there are some pretty valuable, some pretty great questions in there that I answered. So please do reference that. Can you invest with IRA funds? Yes, you can invest with IRA funds. Somebody's asking, what is the next step if interested in investing? Andrew, do you want to?
Yeah, so if you click that link in the chat box and then put in your name and email address, you'll receive an email giving you access to the fund data. I'm sorry, this deal's data room. And then in the data room, and I'll include this in the email, there's basically a green tab that says view subscription package. If you click that, you can execute all of the documents there online. It'll ask you how much you want to invest, your name, your address, if you're investing through a trust or through an LLC or personally, et cetera. With IRA investments, every custodian is different. Some do allow you to go through the portal and just sign everything electronically. Others have different protocols. So I'm happy to work with anyone with their IRA custodian. Questions are coming in.
Yeah, I can't see anyone's ears. I think you meant questions or answers. Not seeing chat room or the Q&A. Is the Q&A not enabled?
Seems like it's coming in.
Yeah.
K1s you'll most of the time get by April 1st. Minimum investment is $50,000. Yeah, it looks like people can't see the other questions.
Oh, interesting.
Can we download them and blast them out?
I will do my best.
So a couple. I'll go over some of the ones that were asked a few times. The loan terms, it's a 3-year bridge loan, a 3+1+1. So it's got a total of 5 years. It is, as of right now, a $28 to $30 million loan. That depends on the 5-year swap. So that's going to be a little bit of a moving target. And the spread is going to land somewhere between 260 and 275. Let's just be conservative, say 275 over SOFR. And with this particular lender, it's the 30-day average SOFR, not term SOFR. So it's a little bit of a lower rate, more conservative. To what extent did the due diligence findings impact renovation estimates? We did a catch-all in our budget called contingency. We put into contingency. We added 500 grand, as well as a few other minor items in the budget. I think that pretty much covers it. We will try to get these questions downloaded and sent to everybody. Any other questions?
The waterfall is 75-25 after an 8% preferred return with a manager catch-up. So it's number 1, preferred return. Number 2, we return capital. Number 3, we get a catch-up. Number 4, the profits are split 75% to the investors, 25% to Trion. And the catch-up just makes it a true 75-25 split. But we don't get our catch-up until you get your pref and your return of capital.
All right.
And this is being recorded as well. So if you joined late or you had to take a call in the middle of it, feel free to email us and we'll send you a recording.
Thanks, everyone. Feel free to email us more questions.
Great. Take care.
Bye-bye.